Have you guys seen The Big Short? If you haven't, it's a great film. But if I wanted to sum up that film in one phrase, it would be counterparty risk. Something a lot of people don't think about. Something a lot of people don't think about when they deposit money in a bank. They think it's safe. Why do they think it's safe? FDIC insurance. Federal Deposit Insurance Corp, I believe that stands for. Now, FDIC insurance covers you for up to $250,000. Now, I want you to ask yourself, do you think the FDIC has 250 up to $250,000 to cover everyone in the United States? No. Okay. So that insurance is there if a bank goes bankrupt, but what they cannot take is a catastrophic failure of multiple banks, which is what happened in 2008. 2008, multiple banks, due to counterparty risk, were failing at the same time. The FDIC did not have enough money to bail out all these people. I'm going to show you guys a couple of videos, if you watch to the end, of how people were reacting back then. But to think this isn't too far in the past, right? This is what was happening in the United States in 2008. Now, the question you should ask yourself is, are we in a better position financially than we were back then? Is the systemic risk in the banking system different today than it was back then? A lot of people say, well, there's new regulation. There is far more borrowing. And all they did in '08 was push the risk up to the federal level. They pushed the risk up to the federal level. Because what happened in 2008? The FDIC insurance could not cover these people. And here's here's the insidious thing. People trust in the FDIC. You always should ask, where's the money come from? Where do they get it? Okay, a lot of banks pay into the FDIC insurance. But if the FDIC does not have enough money to bail you out, what happened in '08? Have you ever heard of TARP, Trouble Asset Relief Program? It's a fancy way of saying the government took taxpayer dollars to bail you out. So they took your own money to bail you out, to bail these banks out so they could have liquidity. Because what happens when you put money in a bank, a lot of people don't know this. You put money in a bank, most people think my money's there. But what is actually happening is banks are taking your money and using it on all kinds of bets. Call it financial engineering, call it whatever you want. But the bottom line is when you put money in a bank, it's not there. Look up fractional reserve lending if you don't believe me. So, what the United States cannot handle is a systemic breakdown in the banking system, including the FDIC, because what they have to do is go to Congress and ask for more money, which is your money. That's the crazy thing. Hey, we need to bail you out with more taxpayer dollars or your great grandchildren's piggy bank because we're going to take on more debt to bail you out. So let's take a look at this video here. I thought this was fascinating because this didn't happen that long ago, folks. And to think that the risk is gone is insane. That's not true at all. The risk is still there, if not bigger today. So this CBS reporter is talking about IndyMac Bank. So let's take a listen.
Opening this morning is sound following the second biggest bank failure in U.S. history. CBS News correspondent Bill Whitaker joins us from Pasadena, California with more. Bill, good morning.
Good morning, Jeff. When this bank reopens this morning, it will be in different hands. The FDICs, or the Federal Deposit Insurance Corporations. The federal government wants to calm customers' jittery nerves and convince them that it's business as usual. But as they say, that remains to be seen. The sign on the bank door says it all. The small print reads, "Closed for business." IndyMac, one of the nation's largest mortgage lenders, was declared unsafe and unsound and taken over by federal regulators.
This bank is now being operated by the FDIC. The FDIC, over the next 90 days or so, will begin to market this bank to try and get it back into private hands.
Over the weekend, the ATMs were operating.
Okay, how did they do that? If a bank goes bankrupt, if their balance sheet is crap, who would want to buy them? Enter Troubled Asset Relief Program, aka taking money, giving it to banks to buy smaller banks like IndyMac. It's insane, folks, because at the end of the day, the dollar is a Ponzi scheme, right? We have to inject more liquidity. And where does that come from? Where does the government get its money? From you, from the taxpayer, or from selling treasuries, which is also from you in the future or your grandkids.
But the bank was closed, even as its new CEO tried to reassure customers.
I want to emphasize that customers should know that their insured money is safe.
But that's not the whole story. The FDIC only insures deposits up to $100,000. Anyone with more than that.
They changed it after 2008 to 250. Again, FDIC only covers about 1% of deposits in the United States. 1%. This is why a systemic problem, which, if you remember the crypto crash of 2022, it was systemic. They lent money to each other, and then if one failed, the other one failed, and then it was this domino effect of multiple crypto exchanges failing because they were lending money to each other. And if you've ever heard my example, which I got from Mark Moss about derivatives, if a derivative is, I have a Snickers bar, I lend it to you, you give me an IOU, maybe with a little bit of interest. And then you have the bright idea to do the same thing. So you lend that same Snickers bar to somebody else with an IOU, maybe with a little interest, maybe with a little more interest because you're paying me interest. And if that continues, let's say there's 5 people, one Snickers bar. If the 5th person decides to eat it, what happens? There was 5 IOUs, or I guess 4 IOUs, in one Snickers bar. So we all go bankrupt. That's how these derivatives work. That's how this systemic problem works. So if 1%, if the FDIC can only cover 1% of deposits, what happens if multiple banks failed, like in 08? They have to go to Congress, hat in hand, or they go to Congress hat in hand, and Congress is like, okay, I guess we're going to approve more taxpayer dollars to bail out the taxpayer. Stupid.
Might be in trouble.
I'm very angry, very upset about this. I wanted to withdraw my money. I've got a CD. I've got approximately $100,000 in Indy Bank.
The one-time mortgage giant is the latest victim of the mortgage meltdown. A week ago, the lender laid off more than half its employees. By Friday, its stock was virtually worthless. With politicians and bankers pointing fingers, New York Senator Charles Schumer vehemently denies that a letter he wrote pointing out risks at the bank triggered this run and collapse.
Everything that was talked about in our letter was already public. So there were no new revelations in our letter at all.
The FDIC has been working around the clock trying to find a buyer for this bank. Ominously, the FDIC says it has a list of 90 troubled banks around the country. And believe it or not, the Indy Mac Bank here wasn't even on the list.
Here for hours. Now
okay, so this is a reporter from a local news station that was going around to these customers because Indy Mac Bank shut down. And think about it. If you have one bank, that's how you pay your bills. These people couldn't even they didn't know what their account balance was, and the website wasn't working, and they just had an FDIC error message. So these people, only way to get their balance and maybe get their money back, was to wait in line to go into Indy Mac Bank. All right, so this reporter is asking these folks how long they've been in line and what they know.
Your name's not on the list.
What?
That's what they're saying.
Well, let me get on another list then. I mean, that's nonsense. This morning, the FDIC announced through the...
So they had this list of people that could take money out, and there were certain people in line who were customers. So the bad communication, obviously, but they had this list, and at the door of the bank, they would say, okay, you can come in and get your money out. And a lot of people who were customers weren't on that list. This lady is one of them.
News, they weren't honoring anybody on this list. It was first come, first serve. They know nothing about this list. It wasn't from them on their official letterhead. Now the same guy who said, I'm not doing a list, is now saying, I'm honoring a list. He's a hypocrite, and he's a bold-faced liar, and this is who's representing us and in charge of our money today? That's nonsense. There are people here who need money to pay their bills. This is nonsense. They should alternate 1-1, 1-1. They should not take the list people first. It should be an alternated thing. I mean, there's one guy that's been here since 11:30 last night. I've been here since 5:30 this morning. I mean, they should have at least had the decency to have a representative out here early. and not wait till 7:45 to start doing this. This is badly managed, and apparently, according to the new CEO of this lovely IndyMac Bank, he was going to make everything run smoother and do what was ever necessary. Well, he ought to get
we're
off.
caught up in the middle of this.
I like that lady. So the same newscaster is now talking to the host, and let's see what the host says.
As you're saying, and just as my wife and I are customers of IndyMac, so we're caught up in the middle of this. And as you're saying, and it just is disinformation because the bank people have told you that the banking machines were working all weekend. That is not true.
Oh, really?
Yeah, we went there on Friday. We managed to pull out $200, but it wouldn't. The main thing is we wanted to know what our balance was. And it won't tell your balance. Then we went back on Saturday and Sunday. The machine wouldn't allow us to pull out any money. It won't even tell your balance. You go on the internet and you can't find your balance. If you go on the FDIC website, they just have that standard, don't worry, and that. So I can't even without having to walk into that bank. So the machines weren't operating in that. So it's that disinformation that they're creating even more of a problem because, and we're going to, my wife and I have to work. We can't line up, but we're hoping.
Okay, so a lot of people are going to learn about counterparty risk. This is why a lot of people are Bitcoin advocates, self-custody, gold, silver, things where the counterparty, a lot of people think there is no counterparty risk with banks. That's not true. I ask you a question. Where did the risk go in 08? Because a lot of banks didn't go bankrupt, a couple did. But there was systemic risk in the system, and the risk kind of disappeared. Where did it go? Where did it go? Because if you went bankrupt and then all of a sudden you're not going bankrupt, how'd that happen? How'd that happen? Well, it happened because we used taxpayer dollars to bail out a bunch of these banks. The question is, are we in the same position today? I think the risk was pushed up to the federal level, pushed up to the national debt level, also known as U, right? The IOU is the American people saying we owe this money. And if you look at the parabolic rise in debt, national debt, since 08, it's astronomical, right? Because we got to keep this Ponzi scheme going. But we live in a thin line between order and chaos. Okay, and that banking system is part of that. Now, imagine if there was systemic risk in the system today and we had to bail out banks again. What is the difference between today and 08? Well, it was about $700 billion that we used for TARP, Troubled Asset Relief Program. How much would we have to spend to bail out today? And what would that do? It would add to the national debt, which in a way puts more liquidity into the system, causes more inflation, and causes people to trust the dollar less. Ultimately, what was happening in 08 was a systemic trust problem because you could trust the FDIC, right? But if the FDIC has to go to Congress and ask for money, essentially from you to bail you out, people start to ask questions, and the government can't have that. That's not good because people start to doubt the integrity of the actual thing they're holding, which may be a treasury or maybe dollars. But the system is so fragile, I think this can happen again. And a lot of people say diffuse your risk by operating in multiple banks. I agree with that. But you have to think about counterparty risk. How many people are between me and the things I'm holding, the assets I'm holding? How many people? And what are they doing with the assets when I put them in the bank? Okay. Do your own research, look that up. But the banking system, if it fails, there's going to be a lot of other things that failed. I don't necessarily think you should take your money out of the bank, put it under a mattress. But this for sure can happen again. It happened not too long ago, folks. And then again, they used taxpayer dollars to bail it out. So they didn't really fix it. The system didn't work. They had to use taxpayer money to bail out taxpayers, also known as banks. Don't you love it? All right, let me know what you guys think in the comments below. I'll see you on the next one. Peace.